Howard Silverblatt is the senior index analyst at Standard & Poor's, and he joins us from his firm's camera here in New York. Howard, good to see you again.
Good to be back.
Howard, you expected third quarter earnings to be down 9.3% versus a year ago. What's going on?
Well, they're coming in better than we thought. The sales are the main item, as you said, 5.3%, and that's the big story. The earnings themselves are coming in right now about 11.9% ahead. So we're looking for the third quarter to be down about 4 to 5%, which is much better than its history. It's improving as it goes forward. But again, the sales are the main item. We're seeing the third quarter the same as we did the second quarter and partially the first. Right. Companies are making their numbers by cutting, and you can just cut so much. And we're not sure how much of the cutting is one-shot deals or for a quarter or two or permanent. But seeing the sales increase with a lower cost factor brings the margins, and that's what we're willing to pay for now. And the market is paying for future earnings. We're not talking about Q4 or even Q1 next year, but into 2010, 2011.
Howard, you talked about sales, but is revenue growth suffering?
Year over year, yes. We're going to be down about 10%, but we were down 19% before. The current sales, this quarter is coming in a little bit ahead, but it's mixed. Up and down the line. 70% of the companies are making it, but a lot of it's in the financials where there's pro formas. IT is doing pretty well as far as the sales go, and they've got consistency. And that's an important item because IT is supposed to increase earnings going down the road, and if they keep those margins, it's going to add to it. But the sales are the place to look at this point in time. The stimulus program, as a couple of companies said this morning, but right now it's still cost-cutting, like Pfizer.
Howard, I also want to ask you about accounting, because that's something you mentioned in one of your releases here. When you're looking at the earnings side, it doesn't affect the sales as much. But how many companies do you see that are sort of tweaking the numbers, if you will, to make them look better?
I won't call them tweaking, but there's a lot of pro formas going out there. Not like it was in 2001 and 2002, but you've got to see what you're comparing them. Companies, especially financials, have picked up other areas and divisions. They've shed some. They've changed the mark-to-market routines. So you really have to dig down, especially in the financials, not as much as the industrials, to see what you're looking at and where those numbers came from. It's not as simple as it looks. It's not that they're cooking books. It's just that there's a different pro forma in there. Right. And there are valid uses for pro formas. I'm not in favor of it, but you do need it at times. There's been a lot of changes out in the market, and companies don't look the way they did last year.
Yep. Howard Silverblatt of S&P joining us this afternoon. Howard, as always, thanks.